chapter 4 of consolidation, that is changes in shareholding. In previous video, we have completed chapter 3, that was goodwill. Now we are going to study chapter 4, that is changes in shareholding. A step acquisition occurs when the parent company acquires control over the subsidiary in stages. Acquisition accounting is only applied at the date when control is achieved. So this is important. Acquisition accounting is applied at the date when control is achieved. The date control is achieved. First, remeasure the previously held equity interest to fair value. Second, recognize any resulting gain or loss in profit or loss for the year or in OCI if share were fair value through OCI. Note if there is any gain or loss due to changes in fair value. If it was previously measured at fair value through profit and loss, so it will charge to PNL, or if it was measured fair value through OCI, then it will charge to OCI. If previously holding was an equity method, then we will calculate the carrying amount of previously holding at, at the date of acquisition. It will compare with fair value and the difference will goes to PNL. So the simple explanation, at the time of remeasurement, the share was previously held under the fair value through OCI. So gain or loss will goes to OCI. If it was measured fair value through profit and loss, then gain or loss, whatever we will have, it will goes to fair value through profit and loss. If it was measured this one, if previously holding was an equity method, then we will calculate the carrying amount of previously holding at the date of acquisition, and it will compare with the fair value and the difference will goes to PNL. So the simple, remeasure the previously held equity interest to fair value, recognize any resulting gain or loss in profit or loss for the year or in OCI if share were fair value through OCI. If gain or loss due to changes in fair value, if it was previously measured at fair value through profit and loss, so it will charge to PNL. Or if it was measured fair value through OCI, then it will charge to OCI. Now, third one, calculate goodwill and non-controlling interest. For the purpose of goodwill calculation, use the following performer: fair value previously held interest, fair value for consideration for additional interest, NCI at acquisition. All three will be added. Fair value of net asset at acquisition, this will be subtracted. So goodwill at acquisition, we will get the amount here. Note when the control is lost, then whatever gain or loss came, it will goes to PNL. If still subsidiary, then it will then gain or loss came will goes to OCE. So if we lost the control, for example, we have 90% and we sold 70%. So now we left with 20% only. So we are not a parent anymore. In this scenario, whatever gain or loss will came, it will goes to PNL. If still subsidiary means we have 90% and we sold only 20%, still we have 70%. In this scenario, whatever gain or loss it will came goes to OCE. If the sale of share caused control over subsidiary to be lost, then the treatment in the consolidated financial statement as follows. Consolidate the income and expense of the subsidiary up until the disposal date. For example, we sold our subsidiary shares on 31st of August, suppose that, and we lost the control. For example, we had 90% share and we sold 60%. So we now left with 30%. So on 31st of August, we lost the control. Therefore, we will consolidate from 1st of Jan to 31st of August. From 1st of September onward, it will not be consolidated anymore. On disposal of the subsidiary, de-recognize its asset, liability, goodwill, and non-controlling interest, and calculate a profit or loss on disposal. Recognize any remeasuring investment in the share of the former subsidiary at fair value and subsequently account for under the relevant accounting standard. Whatever remaining investment in the share of subsidiary, like for example, we left with 30%. In this scenario, what we are going to do? We are going to do the equity counting. Okay. A holding of 20% to 50% of share would probably mean that remaining investment is an associate, which should account for using the equity method. Same. A holding of less than 20% of share would probably mean that remaining investment should be accounted for under IFRS 9 financial instrument. The profit or loss on disposal is calculated as follows: disposal proceed plus fair value of retained interest, calculation of NCI at disposal, NCI at acquisition plus post acquisition profit of NCI, NCI at disposal. When we will add these two, we will get the NCI at disposal value. Goodwill at disposal, we need to subtract it, and net asset at disposal, we also need to subtract it. So we will get the profit or loss on disposal. It can be either negative or positive, means profit or loss. So calculation of interest in subsidiary disposed of, full disposal. Net asset of subsidiary at disposal date, goodwill at disposal date, less carrying amount of NCI at disposal date, interest in subsidiary disposed of. So we will get the value of this. Now partial disposal, no loss control, interest disposed carrying amount equal NCI percent being transferred divided by previously NCI percentage, previously held NCI percentage, multiply by carrying amount of NCI. Partial disposal with loss of control, interest disposed carrying amount equal percentage disposed multiply by net asset at disposal plus goodwill. So first what we have, full disposal. Okay, so the formula of full disposal is net asset of subsidiary at disposal date plus goodwill at disposal date less carrying amount of NCI at disposal date. So we will get the interest in subsidiary disposal, the value of interest in subsidiary disposal, the amount we will get here. Partial disposal, no loss of control, interest disposed, carrying amount we need to find it, NCI percentage being transferred divided by previously held NCI multiply by carrying amount of NCI. And here partial interest, partial disposed with loss of control. Here interest disposed, no loss of control. Interest disposed carrying amount equal percentage disposed multiply by net asset at disposal plus goodwill. Percentage disposed here means, for example, we have 90% and we dispose 70%. So that's 70%. Net asset at disposal, we need to mention the value of net asset at disposal. Generally, it is given in the question plus goodwill. Here, NCI being transferred. For example, we have 90% and we sold 10%. So here, NCI being transferred 10%. Previously held NCI, that will be 10%. Because 90% we have, then we left with 10%, and NCI being transferred, that is 10% new fresh, we need to add it. Multiply by carrying amount of NCI. This is partial disposed, no loss of control. Presentation of disposal. If subsidiary is acquired exclusively with a view to subsequent disposal and it meets the held for sale criteria in IFRS 5, it is presented in the financial statement as disposal group classified as held for sale. This is achieved by amalgamation all its asset into one line item and all its liability into another. It is measured both on acquisition and subsequent reporting date at fair value less cost to sell. So the criteria, if it's met held for sale criteria. Why it's met? Because if subsidiary is acquired exclusively with a view to subsequent disposal and it met the held for sale criteria in IFRS 5, it is presented in the financial statement as disposal group. So we need to show as disposal group classified as held for sale. This is the achieved by amalgamation. We need to amalgamate. We need to do amalgamation of all its asset into one line item and all its liability into another. It is measured both on acquisition date and subsequent reporting date. We need to do the both on the acquisition date as well as on subsequent reporting date at fair value less cost to sale. Okay. Control to control scenarios. Share purchases. Some share purchases simply increase the parent's holding in a subsidiary. For example, 70% we have, it became 80%. So increase in parent holding by 10%. In such case, goodwill is not recalculated because we haven't lost the control. A profit or loss does not arise in the consolidated financial statement. The entry is consolidated financial statement is DR non-controlling interest, CR cash. DR or CR non-controlling, other component of equity. If it is loss, then it will be DR. If it is gain, then it will be CR. The decrease in NCI is calculated as the proportionate reduction in its carrying amount of the date of the group's additional purchase of share. So decrease in NCI is calculated as the proportionate reduction in its carrying amount. At the end, we will see the example how it will be. Now, calculate the value of NCI. Note when the parent will buy additional percentage of NCI. On the day we require to calculate the value of NCI. Example, parent is buying additional 10% of share from NCI. On the day value of NCI is 180 million and before buying NCI is 30%. So here 70% parent is holding. So it's normal that NCI will hold 30%. So the calculation will be 180 multiplied by 10. We are acquiring the percentage of share that is 10 and divided by 30%. We previously hold 30% equals 60 million. Value of NCI we are going to purchase. For example, parent is paid 70 million. So the general entry as follows. Parent is paying 10 million premium. Okay. So the general entry will be DR NCI 60 million because the NCI value is 60 million. DR other component of equity. So as I said, gain or loss, it will goes to other component of equity. Here we are paying 10 million more, so it is loss for us. Therefore, DR. CR cash 70 million. Now, sale of share. Some share sales simply reduce the parent's holding in subsidiary, but do not lead to loss of control. So we call sale of share with no loss of control. For example, 80% becomes 70%. In such case, goodwill is not recalculated because we haven't lost the control. Goodwill is only calculated when we lost the control or we gain the control. A profit or loss does not rise in the consolidated financial statement. The entry in the consolidated financial statement is DR cash, CR non-controlling interest, DR or CR other component of equity. Okay. If we sold our share more than the value of its share, then it will be a profit for us. So we will show that CR other component of equity. The increase in NCI will be calculated the share of the net assets always and also need to add goodwill value if fair value method we are using. If fair value method we are using, then we need to add it. Of the subsidiary at disposal, which parent has effectively sold to the NCI. Always net asset of subsidiary, no need to check the value of NCI. Here we always need to take the net asset, not the value of NCI. For example, net asset of subsidiary at the date of disposal is 80 million. Okay. Net asset of the subsidiary. And we are disposing 10%. Okay. The calculation will be 80 multiplied by 10% equal 8. If it is full goodwill method, then we also need to take goodwill proportion. Proportion of goodwill, for example, if goodwill is 20 million, disposing interest that is 10%, so we will take the 10% of goodwill. 20 multiplied by 10% equal to total, it will be 10 million. Okay. And now, for example, we sold 10% share for 15 million. Okay. So 10% for 15 million. So the journal entry will be as follow. DR cash, because we are getting cash 15 million. CR and CI 10 million. The value of NCI we calculated total NCI value 10 million. And CR other component of equity 5 million. As I said, whenever we will have the gain, it will be credited, and whenever we will have the loss, it will be debited. Now, scenarios in short. 90% becomes 0%, means full disposal. P&L and OCI include the subsidiaries result only up to the date of disposal. Statement of profit and loss. After disposal, you no longer have the subsidiary in group accounts. Recognize any gain or loss on disposal. You stop consolidating at disposal date. We got profit or loss on sale. Okay. P&L or OCI include the subsidiaries result only up to the disposal date. Statement of financial position. After disposal, you no longer have the subsidiary in group accounts. Recognize any gain or loss on disposal. You stop consolidating at disposal date. We got profit or loss on sale. Now, 90% became 60%. Still a subsidiary. P&L and OCI. P&L or OCI. You consolidate for the whole year because control remained. NCI calculation, non-controlling interest. NCI changed during the year. Was 10% became 40%. So split the year into two parts and calculate NCI share of profit in two parts. First part, 12 multiplied by profit multiplied by percentage for the months before change. 12 minus x divided by 12 multiplied by profit multiplied by percentage for the months after change. Now, I have made the example. Let me show you. Calculation of NCI share profit yearly. Example. Year profit of subsidiary equal 120,000. Change happened after 4 months. So X equal 4. Here 4 divided by 12 multiplied by 120,000 multiplied by 10%. Now share of profit. 4 divided by 12 multiplied by 12. 4 months we have gone. 12 its total month. Multiply by 120,000 profit value, multiply by 10% before change, plus this plus is this one. So 12 minus x, this is the month after change. Okay. 8 by 12, 8 months after change divided by 12, multiply by 120,000, multiply by 40%. So the total value from first before change will be 4,000, after change will be 32,000. Total will be 36,000. So NCI is allocated 36,000 of the year's profit is split by the months before and after the change. Now, statement of financial position, consolidate as normal for year end. Closing NCI is being on the year end percentage, that is 40%. Short, still consolidate but compound NCI by weightage month at the old and new percentage. 90% became 40%, became an associate. PNL or OCI consolidate the subsidiary results only up to the date you lost the control. After the date, account for it's an associate, that is equity accounting. Using the equity method, yeah, one more thing. Under equity accounting, we have under associate, we have two choice when we have shares between 20% to 50%, between 20 to 50%, that is associate. So we have two choice that we can either go with equity method or this one cost method. But for the consolidation, we have no choice. We must have to select the equity method. Okay. Use the equity method. Your share of profit or loss shown as one line. A statement of financial position from year end. The investment is shown as an associate equity accounting based on the year end percentage, that is 40%. Short, consolidate until loss of control, then switch to equity method. Now, 90% became 10%. That's called no influence or financial asset. Profit and loss, or OCI. Consolidate up to the date of disposal. Yeah. Consolidate up to the disposal date. After disposal, treat the remaining interest as a financial asset under IFRS 9. So profit or loss, fair value movement, interest, etc. depending on classification. So whatever we have, profit and loss movement, interest, etc. depending upon classification. The statement of financial position from year end, holding is shown as financial asset measured as per IFRS 9 based on year end holding 10%. In short, consolidate until you lose influence, then treat it as a financial asset, not equity or associate. So I hope you understood this. First, we have 90% became zero, full disposal. So we profit and loss include the subsidiaries result only up to the date of disposal. First, we need to understand this. Whenever we lost the control, for that time, we need to calculate the goodwill value and everything, okay, till the date of disposal. But in the scenario, we haven't lost the control. We do not need to calculate the profit or loss, okay. Profit or loss for the consolidation. The profit or loss which we got from the sale of shares, that will goes to other component of equity. That is different. For the profit or loss, we are calculating in the consolidation, that only will be calculated when we sold the control. Okay, when we lost the control. For that scenario, we calculate the profit or loss for the consolidation. Okay, in the scenario we haven't lost the control, we are not required to calculate the profit or loss on the sale of shares. Okay. So all these I hope you will understand. Thank you for this video. In next video, we will discuss chapter 5.